Hello everybody, my name is Avikshit. So here I am starting a new journey of educating all the finance enthusiasts and the stock market people who wish to enhance themselves in the world of investing. So here I will be critically analyzing one of the famous investors of the world. It is none other than Mr. Warren Buffett. In his book Buffettology, he has given the way he chooses a company and the way he values it. And now I am going to break down his method of valuation on how he values a company, how he uses his ratios, and how the valuation is done, and how do you predict the share price targets for the year end in my understanding. So it is purely based on my point of view, my understanding of his concepts, and my application. So without wasting any more time, let's get into one of the models that I have built and how I will value it using the Warren Buffett way. Let's get to it, guys. So let's get to the model. So the company name is BLS International. Please note that this is not any share recommendation. It is just purely for educational purposes and how we understand the Warren Buffett way. So here I've already computed it. Now let us do it from scratch. Okay. So Warren Buffett uses the ROE, which is the return on equity, as a ratio to compute how efficient the company is in growing its shareholders' wealth. So he has a preference for companies with an ROE of greater than 15%, which is the ideal or minimum return that he expects, right? So here we have the BLS company, and its ROE currently is at 34.6%, right? But are we going to take this exact same value? No. We will have take an average of what it has been doing in the past and what it is expected to do in the future. So here I've modeled the company, and I'm seeing that the ROE has gone from 19 to 26 to 27 to 31, and then falling based on a conservative estimate on a base case method. So what I will do is that I will take the year on year average. So firstly, let us compute the target at the end of the tenure. So let's say I want to hold it until FY30, at the end of end of FY31, which is March 2031, which is 6 years from now. Okay, mind you. So for computing the average ROE until FY31, we go to this and we take an average of all this, right? So that comes to about 24%. If we expand, it comes to about 24.45%. Now, the company has historically been paying out a dividend of 10%, more or less. 7, 5, 10, 20, 10, 12, 15, 13, 0. So it depends on the company's capex requirements. But now, for now, we will assume a 10% dividend payout, right? So a payout of 10%, implying that net retained earnings will be this minus 10%, right? 1 minus this into 1 minus this, right? That comes to about 22%, or yeah, 22.01%. Okay, now this net retained earnings is what gets added to the total equity year on year. So we will assume that the total equity, which is the share capital plus the reserves and surplus generally, which we will grow on a 22% growth rate average. So if we take the total equity at the end of FY31, right? So that will be the FY24's total, 25's total equity multiplied by 1 plus, what is the growth rate? 22%. That is the retained earnings which get churned back into the business, right? And the tenure is 6 years. So the formula that I've used is nothing but the compound interest. Compound interest formula is equal to present value into 1 plus growth rate whole raised to the power tenure, right? So this is the compound interest formula, so that we have got, right? So that has been used here to compute the for total equity at the end of FY31. So this grows at a CAGR of 22%. That is what is the assumption, right? So if we have to compute the PAT, which is the sign of, so return on equity, guys, is a formula which is equal to, return on equity is equal to PAT by total equity, right? So if we have total equity, we have ROE. How do we compute PAT? We basically multiply this with this, right? So here is the PAT. Now, what Mr. Warren Buffett says is that you take the PAT, you take the historical price earnings ratio for the 5-year or 10-year average, and then multiply it to arrive at the future market cap or future price per share. Here, I am considering the total equity and total PAT and not the equity value per share or price earnings per share, because in the future there are chances that the company might issue additional shares, it might go for a follow-on public offer, or it may buy back. So EPS is not a very reliable measure, so we take the overall thing. So if we have to compute the so let's take the historical price earnings ratio. Let's go to screener. We have chart price earnings. The 5-year average is at 37 median, and the 10-year average is at 31.4. So let us average 37 and 31.4. Right, we have a 34.2 of a historical PE. So what will be the PAT, the market cap at FY31, which will be this into this, right? So this into this will give me the future market cap. The current market cap, if we see for BLS International, is at 14,662 crores, right? 14,662. So what is the CAGR that we are looking at? And we'll also look at the absolute gain. So first let's compute the absolute gain. This by this minus 1. So that gives me a 226% absolute gain, or 3.26 times, right? So if you look at the CAGR, what is the formula for CAGR? The final value by initial value whole divided by 1 by the 10-year, which is 6 years, right, minus 1. So we are looking at a CAGR of 22% year on year on the share price growth to attain an absolute gain of 226% at FY31. But are we sure that the company retains its moat until the FY31? No, we do not know. So it is necessary for us to compute the year-wise share price target for us to be able to, plan our entry and exits accordingly. The most important thing to know is when to get out of a stock. You will find the valuation, you will make the entry, but the most difficult part of investing is to knowing when to get out, right? So that is why we compute this, and whenever our target hits, we will slowly trim our positions if the economics change, and if not, the moat still remains, then we continue to hold, right? So this is the assumption that we are holding until FY31. But what if we want to exit earlier, right? We of course have these thoughts, and we do not know if the moat will remain so until FY31. So we will have to know what the year-wise share price target is, so that we can plan accordingly. So FY28, FY29, FY30 and FY31, right? So we will take the average ROE until this year. So if I go for FY26, right, if we go to the P&L forecast, so FY26 is here, FY26 is here, and then we have 29%. So this will be the average. But what I will do is that I will fix this reference. If I do it, what will happen is when I drag the formula for the next subsequent years, E27 will remain constant, and as the year passes, that ROE will also be accounted for the average, right? So here we go. This is done. Average ROE until this year is done, right? So once we find the ROE, we would want to grow our share capital. No, first we will take the payout to be constant at 10%, right? So the net retained earnings will be nothing but this into 1 minus this, right? Control R percentage. So we have this as the net, oh my god, yeah, this as the net retained earnings, and this will be the basis for the share capital growth, right? The share capital will, the total equity will grow by this amount year on year. So equity at year end will be previous year, which is in this case FY25, right, into 1 plus this, right? Now I cannot drag because there is a model that I have built, so it would not be appropriate. So for current purposes we will just use this figure, right? So this will be grown now at the rate of 24%, and now I can drag this, right? So I am getting a 6027 worth of equity at year end, right? So let's just verify for a second. C25 into 1 plus D23, yes, D23, yeah, it is perfectly fine. So this is growing by 23%. Just to make sure, what is the growth between this to this? This is 22%, right? So net retained earnings is growing at, so this is the year end equity. So PAT will be what? This into the average ROE. Go, right? So this is also found out. Now we go for the historical PE. Historical PE is nothing but this that we've just found out, and we just copy and paste the values, right? This is done. Now we find the share price target. What is the share price target? Market cap is what we will be looking for. Prior PE into PAT. Control R. That goes on, right? So let us now take the outstanding shares that comes into play. Outstanding shares is what? The current market price divided by the market cap divided by the current market price. The market cap is 14662, current price is 356, right? So 14662 by 356. Outstanding shares is this. Go on. Then we will have the current market price, which is nothing but the future market cap by the outstanding shares, right? So this is the value of the share on a year-on-year basis as per Warren Buffett, right? So this is how Warren Buffett values his company. So if we look at the this is the current, okay, share price, yeah. So the current market price is at 356, right? So absolute gain every year and the CAGR, if we compute. So absolute gain will be this by this minus 1. So we will fix this reference here, B34 will be fixed, and then we just drag it all this percentage. So as we said, 244% is the real value at the end of 6 years at FY31 if we compute the average ROE. So on the average ROE method, would it be 723? Yeah, this is all fine. So the CAGR, if we see, is this by this whole raised to the power 1 by the year. Okay, year I think I missed on putting, I will put it here. Okay, minus 1. Okay, give me a minute. Year 1, 2, 3, 4, 5 and 6, right? So yeah, so here the CAGR has come, right? So we just drag it, but we won't get it because we haven't fixed the reference. B35 remains fixed at all times, right? Now if we drag it, I think we will get it. Yeah. So we are expecting a CAGR of 23% if we compute the year on year growth with the average ROE until that particular year. So with this, you can have an idea of what you expect your share price to grow, and if it does not, then you will have to relook if your company's economics have changed, or if there's any potential threat to competition that has come up. And if it has gone up, well and good, you just book it out. And so always remember, anything that has gone up too fast will come down, and anything that has gone down too fast will go up. I mean, it is not necessary unless the economics are just perfect, but otherwise, if it has gone down without any change in economics, it will rebound. So you can take an example of the COVID crash. So 50% wiped out in a matter of few months, and then boom, recover. Here it was positive Nifty. So that is what we're looking at, right? Um, so this is the expected share price. We can have an idea. We have assumed a historical P of 34.2, which is applicable. So the market may choose to re-rate it if the earnings grow, on very huge numbers. Then probably it will command a higher P. It will go to 40 or maybe 45, and then our value will also go up. So then I think, as per your judgments, you can consider booking a bit, or if you want to hold till 1223, which is the FY31 target, you can certainly hold, which will give you a CAGR of 23%. Then why not, right? The 23% of CAGR is not a joke. That is something fund managers strive to attain even after years of experience. So this is all it is for the Warren Buffett way of valuing a company. So it is assumed that the company picked is a good one, has a moat. Moat means a competitive advantage. It has a moat, it has a sustainable business model. So in this case, BLS, it is a part of the visa consular business. So you have to get any visa appointment, you either go to VFS or BLS. VFS Global or BLS International, right? So VFS is unfortunately not listed, so we can play this team only with BLS. Again, this is not a recommendation. This is purely for educational purposes and to explain how Warren Buffett values this thing. So this company definitely has a moat, so I am confident enough in valuing this company in this manner. But in other, where there industries where there is a threat to competition, then you could potentially maybe reduce your PAT year on year when you build the model. Even here, I've reduced it. If you see, the PAT growth has been phenomenal in the last 3 years, but I've taken a very conservative estimate, and I've even reduced it to be mentally satisfied in true senses. So this is how Warren Buffett values, and if you want more of such learnings, do consider subscribing the channel and following me for more such videos. The next video will be on the Peter Lynch's um, method of stock picking and valuation. Who is the greatest fund manager the world has ever seen? He himself acknowledges, Warren Buffett himself acknowledges Peter Lynch to be better, just because he has generated a staggering 66% or I think 40% CAGR or something. So if we see Peter Lynch CAGR um, performance, I think that's around 29.2%. Damn, is that even a joke? Warren Buffett himself has earned only 23% or so. So 29%, the greatest fund manager, Peter Lynch, will be next in line. So do stay tuned for more, and see you in the next video.